Good morning. This is John McFarland with Miller Johnson's Trust and Estates Practice Group. Welcome to this morning's seminar. Today, we are going to be discussing charitable remainder trusts. We've had a lot of interest and inquiries about philanthropy and charitable planning resulting from the coronavirus crisis and all the difficulties we're facing as a nation. There are a lot of people that want to help. And as part of our philanthropy and COVID-19 webinar series, we are presenting different types of planning vehicles that can be used to help people in need. And it's also a great way to work with a charity and find a way that you can use your assets in a tax-efficient manner to help others. The topics today, we're going to go over the features of a charitable remainder trust. We're going to talk about CRATs and CRUTs. They don't sound very attractive if you by the acronym there, CRAT and CRUT, but that's a charitable remainder annuity trust and a charitable remainder Unitrust. There are four types of CRUTs that we'll talk about today. We'll talk about the taxation of the Unitrust income with the CRUT. And then finally, we'll finish with flip CRUTs and retirement planning. So what is a CRUT, or what is a charitable remainder trust? Whether it's a charitable remainder annuity trust or a charitable remainder Unitrust. These are life income gifts, often referred to as split interest vehicles. And the reason they are described that way, there is a life income component that you receive as the donor, and then there is a remainder interest that passes to charity. And charities love these gifts. They are gifts that charities rely upon for long-term planning. It's a great way to obtain an income tax deduction for the donor. There are opportunities to bypass capital gains taxes, estate tax savings. The donor receives an income stream that can be a fixed or variable income stream that can be for a lifetime or a term of years. You can have multiple income beneficiaries that receive that income. Many times it's a husband and a wife that receive that income stream. And then you can have multiple remainder beneficiaries. So if you set up a charitable remainder trust, you don't have to designate only one charity as the remainder beneficiary. You can list your church, you could list a hospital, a college or university, or any public charity you'd like to list. It's also possible to list a private foundation as a remainder beneficiary. So a lot of opportunities here with charitable remainder trusts, great vehicles, and really a wonderful way to help in this time of crisis. We talk about CRATs and CRUTs. There you see how it's broken down. Let's talk about the CRAT first. And these are not as popular as the CRUT, but they are still attractive for the right person. These are unique because it's a fixed income stream. And with the CRAT, the annuity payment is based upon an initial valuation of those trust assets. It's fixed for the lifetime or the term of the trust itself. There is a minimum payout with these charitable remainder trusts of 5%. And with the CRAT, you cannot make additional contributions. So that annuity payment at the inception is fixed. You receive that if it's a lifetime CRAT for the remainder of your lifetime as the settlor donor. And because it's a fixed annuity payment, the service wants to make sure that a 5% probability test is satisfied from inception. And what that means, there's a formula which is used to determine if the assets of the trust will become exhausted. they want to make sure that there is a charitable gift remaining for the charity at the end of the term, and they also want to make sure that the life income beneficiary will receive that fixed annuity stream. And that's why that 5% exhaustion test is set forth. It is to make sure that those assets are there, both for the charity and the lifetime income beneficiary. Now, the CRUT is a little bit different, and it is a variable income stream. So with the CRUT, there is an annual valuation of the trust assets. And each year with that valuation, you receive a percentage of those trust assets. Again, the minimum is 5%. Say if you set up a trust for $100,000, you get 5% that first year, $5,000. If the assets increase to $110,000 the second year of the trust term, then you receive 5% of that $110,000. So the goal here is to, for most people, not all people, but for most people, is to have an increasing income stream over time. And so if you have growth in that trust principal of, say, 7%, and you're only paying out 5%, you'll have 2% growth built in each year. And as that trust corpus increases, your income, your Unitrust income will increase. So it's a great planning vehicle for someone thinking about retirement, or if someone has a longer investment time horizon, they may want to have that built-in growth or that opportunity for growth as a hedge against inflation. And then also it's good for the remainder beneficiary, because if that corpus grows over time, that means the remainder gift to charity grows over time. So I like the CRUT because the interests of the income beneficiary and the remainder beneficiary are aligned. And it's a great way for a charity to build a relationship with the donor. Those assets are invested by the trustee, and in both cases. But with the CRUT, the investment advisor may have an eye towards growth a little bit more so than with the CRAT. Sometimes with the CRATs, at least in my practice, I've seen maybe the demographics for that type of donor or client, they may be a little bit older, looking for that fixed income stream. Now, last week we had a webinar series and I discussed charitable gift annuities. That would be another option for someone who's looking for a fixed income stream. The difference being that with the charitable gift annuity, the risk is shifted to the institution paying that annuity. So there's no danger of market volatility in terms of the annuity income with the charitable gift annuity paid out to the annuitant, so long as that organization issuing the annuity remains solvent. And with the CRAT or the CRUT, if the assets are depleted, or if there is a downturn in the market, then the income beneficiary is out of luck. I haven't seen that happen in my practice, but it could theoretically happen. That being said, with the CRUT, you want to be careful also when you're working with clients, donors, to make sure they know that if the market goes south, that income stream will also go down. So before I mentioned $100,000 CRUT, and the goal would be to have an increasing income stream over time. If the second year of the credit goes up to $110,000, well, let's assume it goes down to $80,000 the second year. You're then paying out 5% of $80,000 instead of 5% of $100,000. So you do want to be aware of the fact and let clients and donors know that that can go either way when you have the variable income stream. It can go up or down, so long as the client or donor is aware of the risk and knows that there's a risk with market volatility. It is a great vehicle. I'm really think it's a wonderful planning technique. With these, you want to think about the benefits. And really, what I tell people so they can remember is to think of a BIC pen, B-I-C, like a BIC pen, to remember with a mnemonic device. You can bypass capital gains tax. That's the number one feature. You can increase your income over time and then receive a charitable income tax deduction. So bypass capital gains tax, increase your income, and receive a charitable income tax deduction. Those are the main features and benefits of a charitable remainder trust. And what you'll see, and what I see many times, is someone will come to me and they'll say, I have a concentrated stock portfolio. I have this particular asset, and it has a very low basis, and I have all of this appreciation. I'm concerned about market volatility. I need to diversify this portfolio. And you can transfer those assets to a charitable remainder trust. And once they're in that trust, it's a tax-exempt vehicle. So you can sell those assets within the trust and not trigger the upfront gain, which is a tremendous opportunity. And the reason being is, say you have a blue chip stock with a low basis point, a low basis, and you transfer that in, you sell it, diversify that portfolio, and that's where you can have the opportunity of increasing your income potentially, is to have a broader array of investments in that CRUT portfolio, and with the hope that that generates greater income for you over time. And you don't have to worry about the market volatility. So it's a great way to get that concentrated portfolio diversified and do some good and diversify the portfolio. Now, the four types of CRUTs. There is the standard Unitrust, the NI-CRUT, the NIM-CRUT, and then on the next slide, we're going to talk about a flip CRUT. State planners are really something with all these acronyms, but there is a purpose behind each type of vehicle. The standard Unitrust is the basic Unitrust, and it's what I described previously. The payout percentage is determined by, or the payout is determined by multiplying the trust corpus each year by that payout percentage. Now, you can determine and choose that payout percentage when setting up the trust. Again, the minimum is 5%. You don't want to set it too high. You can, but if you do that, you're going to deplete the corpus of the trust. So as long as you're aware of the fact that you could drive that principal balance down and you're okay with it, that's not a problem. But there is one rule that you have to be aware of. It's called the 10% minimum remainder interest rule. And the reason that was put in place, Congress didn't want people setting up these trusts and transferring assets into the trust and then just stripping out all of the income without leaving a remainder gift to charity. So they put in a rule stating that at the inception of this trust, you have to take a snapshot and look at the present value of the remainder interest. It has to be at least 10% when you do that initial calculation. So they want 10% of the initial value to pass to charity in the end when it terminates. So, and the goal there is, you know, it is a charitable remainder trust. You want to leave something for charity. It's just not a tax planning vehicle. So that is put in place to ensure that charities do benefit from these trusts. Now, the NI-CRUT, that the payout is structured a little bit differently. It pays out the lesser of the net income or the stated Unitrust percentage. So in this environment with very low interest rates, you may not get much of a payment with a NI-CRUT because that net income could be very low. But as you'll see on the next slide, what we'll talk about, there is a very good reason to use a NI-CRUT when planning with illiquid assets. The NIM CRUD is similar, but it has a makeup provision. So it pays out the lesser of the net income or the stated Unitrust percentage. But if in a particular year, you don't, the net income is less than the stated Unitrust percentage, you get to make up that difference in future years. So some people like this. It's a little bit trickier from an accounting standpoint for the trustee, but it's nice to have that feature if you want to make up the shortfall if you do not meet that Unitrust percentage amount and you're receiving the net income. So something to think about there. But the NICRUD and the NIM CRUD are both important when planning with a flip CRUD. And the flip CRUD, it's probably my favorite type of CRUD. And the reason being, you see this with real estate oftentimes, or an illiquid asset of some type. And the reason you see it planning with illiquid interest, you have to make that Unitrust payout. If you don't, you're going to disqualify the trust. So what do? Say you have farmland and you deed the farmland into a charitable remainder trust, a standard charitable remainder trust. Well, if that farmland doesn't sell, the trustee has to distribute that Unitrust payment based on the annual valuation. And so you'd end up having to deed out a fractional interest in farmland, which is clumsy and awkward and difficult. And you don't want to be stuck in that situation. So Congress put in place this opportunity where you can have a combination of methods Unitrust. That's what this flip trust is. So initially, it's set up as a NICRUD or a NIM CRUD. So let's use that farmland example. I worked with a gentleman once, many years ago. He was an orthopedic surgeon, and he had farmland. He had a lot of farmland. And this particular property, when he bought it, was just out in the middle of nowhere. But as time went by, the development in his town grew and grew and went right up to the edge of that farmland. And it became very valuable. And he had a lot of gain. And he was concerned, he wanted to sell it, but he didn't want to pay all that capital gains tax. So he set up a charitable remainder trust, and we structured it so that it paid the lesser of the net income until the triggering event. And the triggering event we put in the trust was the sale of the farmland. And so when the farmland sold, it triggered the flip. And so it sold late in the year, in November, and the flip was triggered. And the following calendar year, when we had liquid proceeds from the farm sale, the standard, it converted to, it flipped, that's why it's called a flip, it flipped to a standard CRUD. And then we started to pay out the standard Unitrust payout percentage to this doctor. And so for him, it solved the problem. He had all that built-in gain. He had an illiquid asset. He didn't want to deed out a fractional interest in that farmland, and the net income was very low prior to the sale. He had some income that came in that was paid out from the farming operations, but he was able to pay out that lesser amount, and then after it sold, it flipped, and then he had the proceeds to make the larger 5% payout percentage. So great opportunity for real estate. I've seen this done. You can do it with tangible personal property. There's some rules there you have to be careful of in terms of the charitable deduction, and but it is possible to do that. You can do this with, people have done it with timber, crops, all sorts of different types of assets. I've even seen people do it with automobiles. There was a gentleman that did it with some Rolls Royces that I worked with at one point. So there are opportunities to use these vehicles and do a lot of good with them. How are these taxed? So this is important. And when you're working with your financial advisor, this is important to discuss the taxation of these Unitrusts with the financial advisor. And why is that? Because there's a four-tier taxation structure with these Unitrusts. First, you're going to be taxed at ordinary income, capital gain, then tax-free income, and then tax-free return of principal. So as many of you probably are aware, that ordinary income rate is the highest rate. And then they work down capital gain, of course, tax-free income and tax-free return of principal. So the service is going to tax at the highest rate first and then work your way down. So to the extent that there is ordinary income from the trust investments, that'll be taxed first when it's paid out. And then if there's gain, then gain and down the line there. The income from the asset retains its character. So a lot of people ask, well, if I have that farmland or if I have low basis stock and it goes into the charitable remainder trust, do I ever have to pay the gain? Well, there's an upfront bypass when it goes in, but potentially you would have to pay that capital gain if you get down to that tier 2 level. So say there's no ordinary income and there's maybe some capital gain, and you do eventually work your way into that original gain that was transferred in, that could be taxed coming out in the Unitrust payout percentage. So something to think about, but those capital gain rates are lower. So if you work with your investment advisor and you can absorb some risk, and keeping in mind that you may be subjecting yourself to a little volatility with your portfolio if you're focused entirely on growth. But if you're looking to try to work your way down to that capital gain tier 2 rate, you could be at a 23.8% bracket instead of 37% at that high ordinary income rate. So with proper planning, you can put these assets into these trusts and then try to adjust the portfolio with the financial advisor and trustee to get down to the lower capital gains tax rate. So for younger donors, that's a real attractive opportunity. So I'm in my 40s, so for me, this would be very interesting to set something like this up, maybe with retirement planning in mind. So I put assets in, I invest for growth, knowing that I have a longer time horizon for investing purposes, and there's an opportunity there when it comes out to pay at a lower rate than the ordinary income rate. So attractive opportunities there. And here we see the brackets. You know, the service is going to tax you at the highest rate, and then you work your way down there. Those are the different rates. I mentioned tangible personal property. That capital gain rate is 28%, but that gives you an idea of what you're facing in terms of Unitrust income taxation and the different rates. So this is an example. I used a 75-year-old, and this is good to break it down. I have on this page, I have a 5% Unitrust payout percentage. On the next slide, I'm going to show you a 7%, and we'll look at the difference. So let's say you had $100,000 in stock, cost basis of $50,000. You put this into trust, you transfer it in, you could sell the asset tax-free inside that Unitrust. It generates annual income of $5,000 for the first year. And you bypass $50,000 in gain. So that could save you over $11,000 in tax if you're at the 23.8% capital gains tax rate. That deduction you receive is over $60,000. So if you itemize and you're in that top bracket, that'll save you over $22,000 in tax. Really attractive for someone who is perhaps in retirement. I would think at that age you'd be in retirement. Some people are not nowadays. But you can take an asset that may be concentrated, diversify it, put it in trust, and then you get that income. The projected income for a 75-year-old, their life expectancy is 15.4 years. And so you'd have over $96,000 in income for the remainder of your life. That's a real attractive opportunity. And again, if you wanted to do a 2-life CRUT, you can do that with a husband and wife. And so say the husband passes away, that wife would continue to receive the Unitrust income for the remainder of her life. Now, if you use a 2-life, in a 2-life example, the deduction would be lower because you have 2 life expectancies, and so that deduction would be a little bit lower depending on the age of the second spouse. But as you can see, as I mentioned previously, if that trust earns 8%, the portfolio, and you're only paying out 5%, you have 3% growth, and then the charity ends up with $157,000 and some change there. So you see how this works. The life income gift with the split interest. Again, you have that income interest, the $96,000 going to the donor, and the remainder interest, $157,000 going to the charity. So let's take a look and see what happens. Now look here, the deduction is $60,000 with a 5%, and then the charity receives $157,000 here. So if we go on to 7%, what happens? That deduction drops down to a little bit over $50,000, and the charity receives less, $116,000. So you kind of see how it works here. The higher that Unitrust payout percentage, the more you would receive as the donor. Here it's $115,000 over 15.4 years. On the previous slide, it was only $96,000 over 15.4 years. So it gives, when you play around with these a little bit, you can see how it works with the life income interest and the remainder interest, and how that payout percentage can have an impact on both the income and then the remainder interest to charity. These are, there's an estate tax deduction available. So great if you have a taxable estate to think about a charitable remainder trust for estate tax planning. I have set up testamentary charitable remainder trusts for clients. So you can, through your will or trust, include a provision that would establish a testamentary remainder trust, perhaps for a child, and they would receive an income stream for a term of years, or perhaps a lifetime if they qualify under the 10% minimum remainder interest rule. So something to think about there. You can set these up. There are a lot of different variations. You can set up a life plus term charitable remainder trust, or a 2-life plus term charitable remainder trust. So a husband and wife can set this up so they receive an income stream for their joint lifetimes, and then add a term not to exceed 20 years for their children. So their children could continue to receive that Unitrust income stream for that 20-year term after the parents pass away. So a lot of flexibility with these, and you can do a lot of different things with the planning. This again, the flip Unitrust for retirement. So I had mentioned for someone who's still working, if they want to set this up, you can set the triggering event as a date certain. So say you want to retire when you're 65, you say, set that date as the triggering event, so the trust converts from a net income trust to a standard charitable remainder trust upon retirement. So you're paying less in income during those early working years with the NICRUT, and then it converts to a standard CRUT when you turn 65, and it pays out, say, a 5 or 6 or 7% Unitrust payout when you need the income in retirement. So it's interesting. People don't think of charitable planning for younger people, but this is an example where it would work. You think about it like an IRA. The Unitrust is tax exempt, so those assets inside the trust are growing, free of income tax until they're paid out. So it's a great way to tuck away some assets and plan for growth, maybe when you're younger, and pay out the lesser of the net income or the stated Unitrust percentage. And then when you have, you reach that retirement age that you set in the document, you could pay out that standard Unitrust payout percentage. So a lot of opportunities there for retirement planning, for planning with illiquid assets like real estate. You can even use some business interests as well. Gets a little bit more complex there, but that's also available. There's just a lot of flexibility here. Another thing to think about with the Secure Act that just came out recently, that made it difficult for non-spousal beneficiaries of IRAs to defer tax with IRA planning. So what you can do in that situation, you could set up a charitable remainder trust and have your IRA go directly to the charitable remainder trust and name your children as the beneficiaries of that charitable remainder trust as the life income beneficiaries. And that asset going in, it's not going to trigger the ordinary income upon transfer to the charitable remainder trust. It would be taxed when it's paid out in the form of ordinary income taxation when the Unitrust payout is paid out. But there's an opportunity there to soften the tax bite of the IRA when you have a non-spousal beneficiary. So that's a technique that is being discussed more and more after the passage and implementation of the Secure Act. So something to think about there. And it provides, again, a way to soften the tax burden on those non-spousal beneficiaries. They'd be a beneficiary of the CRUD. The IRA would pass to the CRUD, and then the CRUD would pay the Unitrust income to the children as the beneficiaries, and then ultimately the remainder interest would pass to charity. So a lot of opportunities, a lot of flexibility in planning with these vehicles, great vehicles. Remember the benefits of the charitable remainder trust: bypass capital gains tax, increase income, and receive a charitable income tax deduction, BIC, just like the Big Pen. So that's an easy way to remember the benefits. If you have questions about charitable remainder trusts, or if you have questions about plan giving or charitable planning, feel free to email me, give me a call. I really enjoy this topic and am happy to speak with you about it if you have questions. Wanted to share with you the information regarding our Miller Johnson Back to Work Resource Center. There are a lot of questions out there. Look at our website. We have a lot of information. People are asking about employment issues and all sorts of issues companies are facing with employees going back to work at some point. We're not sure quite when for a lot of people, but a lot of resources available on the Miller Johnson website. I encourage you to take a look at that. And we appreciate you listening in this morning. And again, give me a call or email me if you have any further questions about charitable remainder trust or estate planning or plan giving in general. With that, we will conclude this morning's seminar. I thank you for your attention, and we'll close it out with that. Thank you.